Warren Buffett calls this book, by far, the best book on investing ever written. The Intelligent Investor was written by Benjamin Graham, and it had a profound impact on Warren Buffett when he first read it back in college. The lessons in this book were instrumental in shaping Buffett's investment philosophy. While it does focus on stocks, it also provides a timeless perspective on how to approach investing wisely. In this video, I'll share the key takeaways and my personal insights from this 648-page classic. If you're ready to invest smarter, let's dive into the 5 essential lessons this book has to offer. Buffett says, "Chapters 8 and 20 have been the bedrock of my investing activities for more than 60 years. I suggest that all investors read those chapters and reread them every time the market has been especially strong or weak." Chapter 8 explores market volatility, while Chapter 20 dives into the concept of the margin of safety. We'll take a closer look at these chapters, as they're essential for any investor. As Buffett often says, money is simply a tool to give us the freedom to do what we love every day. So, let's dig a little deeper. Imagine you bought a $100,000 house, and every day, this emotionally unstable guy named Mr. Market knocks on your door from 10 a.m. to 6 p.m., trying to make you offers on what you own or want to own. One day, feeling super optimistic, he offers $170,000 for your $100,000 house. Then, a year later, he's so scared that he offers just $70,000, even though the rental income from the house has doubled in that time. Would you really let this unpredictable guy decide what you own or what you should buy? Of course not. That'd be crazy. Mr. Market is just a metaphor from the book, teaching us to avoid emotional decisions when evaluating stocks. You've probably noticed how the market swings wildly between crazy optimism and unnecessary pessimism. The goal is to look at stocks as logically as you can. Here's the core of Graham's idea. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business. The good news is, you can totally take advantage of Mr. Market's weaknesses. You don't have to follow his lead. When he's way too excited, sell your stuff to him. And when the market crashes, jump on the chance to buy. Okay, maybe it sounds a bit like loan sharking, but you get what I mean, right? We're hit with news, rumors, and market drama 24/7. Basically, Mr. Market is always hanging around. Smart investors buy from the pessimists and sell to the optimists. Seriously, take this principle from Benjamin Graham to heart. Remember what Graham said. When you buy a stock, you're not buying a piece of paper. You're buying part of a company. Buy Tesla stock, and you're basically partners with Elon Musk. Buy Amazon stock, and you're teamed up with Jeff Bezos. Their success is your success. Fluctuations are a natural part of investing. In fact, they're part of the game. Here's a simple prediction. At some point, the stock market will take a nosedive. We all know that. But are we prepared for it, both financially and psychologically? Let's revisit a timeless piece of investment wisdom. Be fearful when others are greedy, and greedy when others are fearful. A smart investor doesn't completely ignore Mr. Market. Instead, they take advantage of his mood swings, but only when it's in their best interest. The biggest difference between an investor and a speculator lies in how they approach market movements. Speculators focus on predicting and profiting from market swings, while investors aim to buy quality stocks at good prices and hold on to them for the long haul. Price swings give real investors one key opportunity: to buy smart when prices plunge and to sell smart when they skyrocket. At other times, smart investors focus less on the stock market and more on dividend yields and company performance, making them more likely to succeed. In the end, keeping a long-term perspective when investing in the stock market is key. Graham reminds investors to avoid getting caught up in short-term market noise and instead focus on the real value of the businesses they invest in. When you're starting out with investing, it's super important to pick a strategy that works for you. You'll need to figure out if you're more of a defensive investor or an enterprising one. Let's first talk about the defensive investor. A defensive investor likes to play it safe, so their main focus is on security. And the best way to achieve this kind of security is through diversification. Benjamin Graham suggests splitting your portfolio into 50% stocks and 50% low-risk bonds, like interest-bearing debt securities. If you're worried about interest rate risks, you can diversify the low-risk part even more with things like foreign currencies, gold, or fixed income assets, depending on your investment style. The choice is yours. What really matters is understanding the main idea. The main idea here is to keep both your risk and return at moderate levels. In other words, it's all about balance. Lower risk means lower returns, while higher risk could lead to higher returns, but also bigger losses. For example, let's say you start with this 50-50 split. Over time, as your stocks grow in value, your portfolio might shift to 70% stocks. To restore the balance, you'd sell some stocks and reinvest in lower risk assets. This not only locks in your profits, but also brings your portfolio back to a stable position that can handle market ups and downs. Your stock portfolio should also be diversified. Focus on large, well-established companies with a proven track record and aim to spread your investments across at least 10 different companies to lower your risk. At first, finding 10 solid companies might feel overwhelming. A helpful trick is to check out the portfolios of reputable mutual funds to see which companies they're investing in, and then build your own portfolio from there. Yahoo Finance is a great tool for this. I highly recommend it. To sum it up, a defensive investor spreads their investments across 10 to 30 companies and avoids putting too much money into a single sector. Look for companies with a long history of paying dividends. In the US, a 20-year track record is pretty standard. Focus on large companies. Make sure the companies have a strong current ratio, with assets at least twice their liabilities. Over the past decade, these companies should have shown at least 33% growth in earnings, which means about a 3% annual increase. Don't overpay for stocks. The price shouldn't be more than 1.5 times the company's net asset value, assets minus liabilities. Also, avoid overpaying for earnings. Stick to companies with a PE, price to earnings ratio, below 10. This is just a starting point, and there's definitely room for a deeper analysis. But even the simple approach can help you avoid big losses and get you off to a solid start. Sometimes, simplicity works better than overcomplicating things. Once you've chosen the companies you want to invest in, the next step is deciding how much money to invest and regularly reviewing your portfolio. A good strategy is to invest a consistent dollar amount at regular intervals, like every month or every 3 months. For example, you could buy $100 worth of stocks every month. This method, often called dollar cost averaging, works well for most people. For most people, the defensive investing style makes more sense, since we don't always have the time to dive deep into research. This approach, championed by Benjamin Graham, offers a safe and steady path to grow your wealth. While a defensive investor is happy with steady, reasonable returns, an enterprising investor sets their sights on beating the market. To succeed, an enterprising investor needs to be both experienced and well-informed, and that means dedicating a lot of time to the process. Even professional investors often find this approach challenging, since they can easily get caught up in Mr. Market's unpredictable pricing swings. Investors who go for this strategy tend to look into riskier stocks that could bring bigger returns. As you can imagine, the rules for this approach are a lot more flexible. Benjamin Graham observed that the market often overvalues companies with rapid growth or flashy appeal, while undervaluing those that seem less impressive in their progress. That's why the intelligent investor avoids growth stocks whenever possible. But why? It's because investment decisions often depend on future earnings, which are naturally less reliable than current valuations. To sum it up, while a defensive investor focuses on avoiding risks, an enterprising investor aims to maximize returns. The margin of safety is a cornerstone of value investing, a long-term strategy of buying undervalued assets and holding them until they reach their true value. In simple terms, the margin of safety is like a cushion that protects investors from unexpected losses. Benjamin Graham describes the margin of safety as the difference between the intrinsic value of a stock and its market price. For instance, If a stock's true value is $50 but it's trading at $40, the $10 difference is the margin of safety. This means that even if the stock's value drops a bit, buying it at a discount protects the investor from major losses. Graham stresses the importance of using the margin of safety to reduce risk in investing. He advises investors to buy assets only when they're priced well below their true value, as this acts as a safety net against potential losses. In short, the margin of safety is a must-have tool for value investors. It helps minimize risk and boosts the chances of long-term success in the stock market. Benjamin Graham highlights the importance of understanding a company's value and practicing patience for anyone aiming to succeed as an investor. To figure out a company's true worth, you need to be ready to dig deep and do your homework. After buying a company's shares, you've got to be patient and wait for the market to recognize the stock's true value and for its price to go up. At the end of the day, it's up to you to figure out your own investing strategy. The insights in this book are, no doubt, game-changing. For instance, as an enterprising investor, I go for companies with high P/E ratios based on future growth potential, while as a defensive investor, I prefer companies with strong dividends. That said, neither my approach nor Benjamin Graham's advice might be the perfect fit for you, because only you know your situation. In the end, it's your hand that shakes hands with Mr. Market.